Welcome back to BizIntel, our weekly briefing that looks beneath the surface of the quiet shifts reshaping the global economy and the tech industry. If you're still expecting AI to be a magic wand that delivers lighter work and higher pay in 2026, it's time for a more grounded view. Over the past week, Silicon Valley has sent a blunt message. AI is no longer a promise of the future. It has become a brutal cost equation, and not everyone can afford to stay in the game. The era of rose-colored AI, fueled by overly optimistic expectations, is steadily cooling. As we enter early 2026, the tech world is no longer talking about abstract superintelligence. Instead, the conversation has shifted to hard constraints. Financial pressure, energy infrastructure, regulatory barriers, and above all, the market's finite patience. The age of billion-dollar valuations built on glossy demos is drawing to a close. From Apple being forced into closer cooperation with Google, to Meta running its AI infrastructure more like a commodities exchange than a software platform, the signs all point to the same conclusion. A new phase defined by operational discipline and ruthless selection. Join BizIntel. We break down the realities behind this changing landscape and what they mean for the year ahead. The rose-colored AI boom is over. What lies ahead in 2026? The uncomfortable truth behind polished AI demos. The most jolting development of the past week came from Apple, which officially confirmed that it will use Google's Gemini model to upgrade Siri. For a company that has long taken pride in controlling everything from silicon to software, this move is more than a strategic compromise. It is a cold splash of water on a decades-old philosophy of self-reliance. The roots of this decision trace back to Craig Federighi, Apple's head of software. While Federighi projects energy and confidence on stage at WWDC, internally he is known for a strict approach to spending. He scrutinizes everything from infrastructure costs down to office perks. At a time when the tech industry is pouring tens of billions of dollars into AI, Federighi has held onto a mindset closer to that of a chief accountant. Don't spend unless the return is unmistakable. That discipline, however, left Apple's internal AI models struggling. They were not smooth enough, not capable enough to compete with GPT or Claude, and most critically, they were not ready in time. The result was a domino effect of delays. Apple's conversational Siri overhaul was pushed back, stalling the AI wearable project slated for 2027, whose entire user experience depends on Siri. Even a rotating screen device similar to an iPad was postponed for the same reason. In the end, Federighi was forced into an unthinkable choice, relying on Google. Apple's decision to use Gemini, along with Google's cloud infrastructure and TPU chips, marks a painful strategic reversal. The lesson is brutally practical. In business, excessive frugality can become the most expensive mistake of all. The open question now is whether Apple can reclaim its autonomy or whether it will remain a follower in a game whose rules have already changed. If Apple represents the fear of spending too much, OpenAI stands at the opposite extreme, embracing aggressive spending and organizational chaos. Far from the ideal of a research lab building artificial general intelligence for humanity, OpenAI is experiencing a clear identity crisis as it transforms into an enterprise software company. When Sam Altman invites heavyweight CEOs like Bob Iger to San Francisco, it is no longer to discuss the future of humanity, but to pitch corporate solutions. At the same time, OpenAI's plan to introduce advertising on ChatGPT, priced at $60 per thousand impressions, on par with some of the most expensive NFL broadcasts in the world, positions the company as a premium media platform. Yet unlike Google or Meta, OpenAI does not offer advertisers deep behavioral targeting data. Instead, it relies on an old television-style ad model with limited transparency around conversion and effectiveness. CFO Sarah Fryer has gone even further, floating the idea of value sharing. OpenAI would claim a share of downstream revenue if customers, such as pharmaceutical companies, make breakthroughs using GPT-5. This bold proposal would turn OpenAI from a tool provider into a profit-sharing partner, opening the door to significant legal and ethical risks. Behind these strategies lies an increasingly fragile internal culture. Of the company's 11 original co-founders, only 3 remain. High-profile departures, including Mira Murati and Greg Brockman's extended leave amid workplace pressure, have exposed deep fractures. OpenAI is attempting to balance research and commercialization using what insiders describe as chaotic energy. Under mounting financial pressure, it is far from clear how long that balance can hold. While OpenAI chooses speed and disruption, Anthropic has taken a slower, quieter path, one that has earned trust among some of the most demanding customers. Rather than expanding in every direction, Anthropic has focused on specialization. This week, the company released an updated constitution for Claude, outlining how the model should behave in ambiguous situations. Compared with its 2023 version, the new document relies less on rigid rules and treats Claude as a system capable of judgment rather than a machine that simply follows orders. Notably, the document leaves open the possibility that AI could one day possess a form of moral status. This is not merely philosophical positioning, it is a trust-building strategy aimed at enterprises that prioritize compliance and legal risk. The market response has been telling. Claude Code is gaining ground in enterprise settings, with many companies spending millions of dollars per month on both platforms, yet reporting that Claude delivers greater practical value for engineering teams. Anthropic is not trying to build an all-knowing chatbot, it is building a highly competent collaborator. Financially, Anthropic is now expected to surpass OpenAI in enterprise API revenue, a remarkable outcome given OpenAI's early lead. The takeaway is clear. In the AI race, moving slowly but steadily can sometimes produce more durable advantages than sprinting ahead on unstable footing. 3 distinct AI strategies among industry giants are now leading to sharply different destinies. Infrastructure, the battle for power, land, and chips. Before we go any further, let's momentarily forget about chatbots. Forget prompts, benchmark scores, and debates over which model is smarter than which. This section is not about AI as a product you can test drive. It is about AI as a very real, very heavy, and extremely expensive physical system. One that requires electricity, land, chips, cables, and hundreds of billions of dollars in capital. And it is at this layer that many AI dreams are beginning to run into serious trouble. If earlier sections showed differences in philosophy and speed among AI companies, the divide here comes down to a far simpler question: who can actually operate AI in the real world? Mark Zuckerberg appears to have recognized this problem early. Over the past week, Meta made a strategic move by creating Meta Compute, a centralized infrastructure unit focused not on research but on coordination. Decisions about computing capacity, energy, and supply chains have been elevated to the highest management level. Zuckerberg also expanded his list of direct reports to include 2 key figures: Santosh Janardhan, head of global infrastructure, and Daniel Gross, head of AI operations. Notably, the hiring criteria for this group go far beyond deep learning expertise. Candidates are expected to understand supply chains, commodity markets, energy systems, and even national-level finance. In practice, this looks less like an engineering team and more like a commodities trading desk at an investment bank. Meta is running AI the way financial institutions manage oil or precious metals, forecasting long-term demand, locking in future contracts, and squeezing efficiency out of every percentage point of electricity cost. At this scale, AI has shifted from an algorithmic challenge to a logistics and operational discipline problem. Meta's bet is enormous. More than $600 billion in AI infrastructure investment in the US through 2028. The risk, however, is structural. Unlike Microsoft or Google, Meta does not operate a public cloud business that can rent out excess capacity. If it overbuilds, it eats the losses. If it underbuilds, it falls behind. This is an all-or-nothing gamble that has made Wall Street uneasy. Since announcing its massive spending plans, Meta's stock has fallen sharply. This reflects fears that the pace of AI spending is outstripping the company's ability to earn it back. In the AI chip world, NVIDIA remains the central force. But this week made clear that power now comes not just from performance, but from financial backing. NVIDIA recently invested an additional $2 billion into CoreWeave, raising its ownership stake to more than 11%. In return, CoreWeave committed to buying future generations of NVIDIA chips, including the upcoming Rubin line. This is a classic lock-in strategy, designed to secure demand as large cloud providers race to develop their own in-house chips. Google, however, is playing a more subtle game with its TPU chips. TPU's competitiveness is not just technical, it is financial. Google is willing to underwrite debt and long-term leases for partners that build data centers around TPU. A guarantee from Google dramatically lowers borrowing costs and risk for infrastructure companies. In corporate finance terms, this advantage can be more valuable than a few extra percentage points of performance in benchmark tests. When data center executives start viewing TPU as a long-term financial instrument, it is a clear sign that the AI chip war has moved from the lab into the banking conference room. This shift was evident last week when the global data center industry gathered in Hawaii for the annual Pacific Telecommunications Council conference. The message was unmistakable. 2026 is the year of execution. After a breakout 2025 filled with mega projects like the $500 billion Stargate initiative, there is no longer room for glossy PowerPoint slides. Everything must now be proven on the ground with concrete, generators, and fiber cables. The biggest obstacle today is no longer capital or engineering, but local opposition. Data centers are facing growing backlash for their water usage, rising electricity prices, and environmental impact. In many regions, securing construction permits has become harder than raising funding. To soften resistance, industry insiders have begun using gentler language, cloud pods, or connectivity hubs instead of data centers. OpenAI and Microsoft have even been forced to roll out formal community engagement plans, pledging local investment as a condition for keeping projects alive. All of this makes one thing clear. AI no longer exists in an abstract digital space. It occupies land, consumes power, and directly affects daily life. Society's patience is becoming the new limiting factor for technology. AI today is not constrained by intelligence, but by operational reality. Where electricity does not generate itself, land is finite, and capital is no longer cheap. The game has shifted from who has the best ideas to who can absorb higher costs and maintain stricter operational discipline. That shift, more than any breakthrough model, will determine who survives once the hype fades. Markets and valuation, bubble or real value. When a technology enters a phase of maturity, financial markets are often the fastest to react, and also the most distorted. If you want to know whether AI is being treated as a bubble or as real value, look closely at how it is being priced in capital markets. The past week exposed a sharp paradox. The companies performing best operationally are not necessarily valued fairly, while those facing the most challenges can still become magnets for capital. Intel and TSMC now represent two opposing extremes, where market valuation appears to move in direct contradiction to business fundamentals. Intel, despite missing the AI chip wave and still struggling with its legacy CPU business, is trading at roughly 20 times forward EBITDA. TSMC, by contrast, the undisputed giant of global semiconductor manufacturing, with revenue growth of 36% in 2025 and an expected 30% in 2026, is valued at around 12.5 times. On a purely financial basis, this gap borders on the irrational. Intel's revenues continue to decline, with growth expectations of just 2 to 3% next year. Intel's premium valuation has little to do with technology and everything to do with politics. The U.S. administration's announcement of a plan to acquire a 10% stake in Intel as part of a national semiconductor strategy, alongside participation from SoftBank and NVIDIA, has turned Intel into a symbol of supply chain security. Capital flowing into Intel is not betting on engineering excellence, but buying political insurance. Analysts, however, are warning that Intel is priced far above its realistic outlook. It is a stark reminder to investors. Valuations driven by hype or geopolitics may persist for a time, but when business reality fails to catch up, corrections tend to be swift and brutal. If Intel illustrates distortion in the US market, China is building a very different kind of AI bubble. Since December, at least 6 domestic AI and chip companies have gone public, raising more than $4 billion in total. The shock is not the amount raised, but the valuations. Biren Technology is trading at 248 times revenue, Zhipu and Minimax at 178 times and 252 times, respectively. For comparison, NVIDIA trades at roughly 24 times revenue, while OpenAI is expected to sit around 57 times projected 2026 revenue. This exuberance is driven by a strategic objective rather than near-term performance, building a self-sufficient AI ecosystem free from dependence on the United States. The Chinese government is mobilizing capital, policy support, and political will behind this goal. Yet the technical gap remains significant. Domestic chips still trail NVIDIA in performance, and local AI models have yet to surpass OpenAI or Google on global benchmarks. What we are seeing is a market driven more by expectation than by demonstrated capability. That dynamic was on full display this week when Zhipu announced an image generation model trained entirely on Huawei chips without relying on foreign components. The stock surged 40% on the news. While this is a meaningful milestone, it also underscores how early-stage China's AI journey still is. The market's explosive reaction to such a step reflects the intense pressure for technological independence weighing on every layer of its ecosystem. While China's IPO market is heating up, global mergers and acquisitions are entering a far more grounded phase. The clearest example is Brex, the corporate credit card startup once valued at $12.3 billion in 2022, which has now agreed to sell itself to Capital One for $5.15 billion. This is not a glamorous deal, but it is a pragmatic one. Brex's leadership appears to understand that the era of double-digit unicorn valuations is over. Locking in a reasonable outcome today is better than prolonging uncertainty. Early investors such as Green Oaks will still exit with gains, while later entrants may only break even. Brex has become a textbook case of startups born in the era of cheap money confronting a much harsher reality. Amid this landscape, Zoom has emerged as a rare and unexpected bright spot. Long dismissed as a post-pandemic relic, Zoom's stock jumped more than 10% after investors recognized the hidden asset on its balance sheet, its stake in Anthropic from the 2023 Series C round. At the time, Anthropic was valued at roughly $5 billion. Today, that valuation has surged into the hundreds of billions. What once seemed like a peripheral strategic investment has suddenly become a windfall, reshaping how the market views Zoom's future. At a deeper level, the venture capital industry itself is undergoing a painful shakeout. Data from Sapphire Partners shows a rapid rise in so-called zombie funds, firms unable to raise new capital, leading to a decline in the total number of active funds for the first time in over a decade. Of the funds launched in 2021, only about 30% have successfully raised a second fund. For the 2022 vintage, the figure is even lower. Capital has not disappeared. It is concentrating around large, established funds with proven track records. Smaller or underperforming firms are being left behind, marking a complete reversal from the era of easy money. For startups, the immediate consequence is less experimental capital and far greater pressure to deliver efficiency and real returns. Growth at all costs is no longer tolerated. Only models that generate genuine cash flow can survive. The market signal could not be clearer. The age of storytelling is over, and the age of interrogation has begun. Companies unable to demonstrate real value will be filtered out quickly. AI is not immune to this process. If anything, its massive operating costs place it under even harsher scrutiny than most sectors. In this environment, true value is beginning to separate itself from the bubble. Labor and society. AI is not making jobs disappear. It is redrawing value. So far, everything we've discussed has revolved around companies, strategies, infrastructure, and capital markets. But there is a far more important and far more personal question. What about people? If you're listening to this episode as a working professional, a student about to graduate, or simply someone worried about your place in the next few years, this section is for you. Because the biggest impact of AI is not how intelligent it becomes, but how quietly it is changing the way we define the value of human labor. AI is not wiping out jobs overnight. Instead, it is creating a deep divide within white-collar work. In 2026, jobs still exist, but the labor market is becoming harder to navigate for those who adapt too slowly. The data reveals a paradox. The U.S. continues to add millions of office jobs, and average wages in professional services are up roughly 5%. Administrative roles have even seen wage increases of as much as 17%. But these figures mask a deeper shift, the rise of the cyborg worker as the new norm. In this model, an employee's value is no longer measured by how many tasks they complete, but by how well they combine human judgment with machine speed. Hybrid roles that blend technical knowledge with coordination and oversight, such as project managers, security specialists, and business technology liaisons, have seen demand rise by as much as 30%. Meanwhile, purely administrative jobs like insurance processing or office assistants have declined by 13 to 20%. These are repetitive roles that require little judgment, exactly the kind of work that agentic AI systems and Gen AI co-pilots of 2026 handle best. The market's patience is now reserved for people who can use AI to create new value, not just complete tasks machines already do well. The group feeling the greatest pressure is young workers entering the job market. Anthropic CEO Dario Amodei has made a controversial prediction. AI could eliminate up to 50% of entry-level white-collar jobs. The logic is straightforward. These roles typically involve repetitive work, few edge cases, and limited independent judgment, prime territory for AI systems. When AI can handle half the workload of a junior employee, companies begin asking hard economic questions. Why invest heavily in training inexperienced workers when AI delivers comparable output with lower cost and risk? Research from the Center for the Governance of AI suggests that clerical and administrative workers face the lowest adaptability, largely due to limited pathways into higher value roles. This is no longer speculative. JP Morgan CEO Jamie Dimon has stated openly that the bank will need fewer people in the future. Amazon continues to cut thousands of corporate roles, not because of financial distress, but because technology has allowed it to do more with fewer employees. The traditional entry door into the workforce is narrowing, forcing younger generations to rethink their skills and positioning with unprecedented urgency. One point must be made clearly. AI does not only destroy, it restructures and creates new forms of work. Roles such as data labeling specialists, AI deployment engineers, and even chief AI officers at the executive level are emerging rapidly, though many still lack standardized job titles. U.S. labor data shows that the fastest-growing job categories carry vague names like other science and mathematics occupations or other information technology roles. Since late 2022, these groups have grown between 40 and nearly 60%, accompanied by strong, real wage gains. What these roles share is multidimensional skill sets. They are hard to capture in a single job description and nearly impossible to automate fully. They require systems thinking, contextual understanding, and most importantly, the ability to take responsibility for outcomes. Jobs are not disappearing. They are shifting toward forms that demand higher levels of judgment, coordination, and accountability. To complete the global picture, look to China. This week, China's Ministry of Agriculture warned that migrant workers are increasingly choosing to remain in rural areas after the Lunar New Year instead of returning to cities. The reasons are structural. A frozen real estate market has crushed construction, export factories are short on orders, and AI-driven automation is steadily encroaching on manufacturing lines. The case of Mr. Zhu, a 60-year-old construction worker, is emblematic. His monthly income from tiling fell from 9,000 to 5,000 yuan, forcing him to leave the city early due to lack of work. Yet rural areas are no longer a safety net. More than 40% of households have already leased out their land use rights. When cities can no longer absorb labor and rural areas no longer offer land to fall back on, a dangerous social gap begins to form. This is an early version of what could unfold globally when technology advances faster than human adaptation. Viewed as a whole, AI is not eliminating jobs in dramatic fashion. It is removing roles that no longer generate sufficient value in the new system. Labor value is shifting from how much you do to what you are accountable for. In that world, the advantage belongs not to those who merely know how to use tools, but to those who understand systems, manage risk, and take responsibility for final outcomes. Where do you stand in this selection process? When the pieces of this week's story come together, a new boundary becomes clear. AI is no longer the domain of dreamers. It has become a real operating system, one defined by costs, legal responsibility, and brutal execution pressure. At the corporate level, the game is splitting apart. Apple trades self-reliance for speed. OpenAI embraces chaotic energy to stay ahead. Anthropic quietly builds trust with enterprise customers through discipline. On the infrastructure front, AI no longer floats abstractly in the cloud. It has landed on the ground, with hard problems involving power, land, and suffocating political negotiations. Any player unable to turn ideas into concrete, cables, and contracts will be pushed out, regardless of how smart their algorithms may be. This divide extends into financial markets and labor alike. As capital becomes less blindly optimistic, valuations based on hype or political guarantees will collide with business reality. In parallel, labor value is being rewritten. Repetitive roles are fading, replaced by workers who can operate systems and manage risk. Entry-level doors are narrowing, forcing every individual to ask a difficult question. Where does my value sit in an ecosystem that is becoming more complex and more expensive by the day? As AI begins to carry a real price in money, energy, and social impact, the gap between those who talk about the future and those who execute it will only widen. In this process of selection, are the skills we are building strong enough to stand once the artificial hype fades? Thank you for following BizIntel. See you in the next video.